Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. In a week when the UK general election moved on with the publication of all the parties' manifestos, but no change to the expected outcome of a Labour landslide, the great will they won't they cut interest rate soon saga continued, with this week the latest US data reading showing better than expected inflation performance last month, countering the worse than expected reading from the month before, prompting a welcome decline across the curve in bond yields both in the US and on this side of the Atlantic. That in turn prompted what seemed at first glance like an as-you-were story in equity markets, with the US indices led by Nasdaq moving higher again, followed by the still hot Indian market and the persistently resilient Japanese indices. That mood did not have a shift to the UK market for whatever reason, with the FTSE All-Share off a short 1.5% and most other broad UK and European market indices down on the week as well. Turning to the investment trust universe, the investment trust index was down by just over 1%, with losers outnumbering gainers by around 2-1. Notable among the gainers were the Indian and tech trusts, while the longer list of losers was headed by the usual cast of smaller, more volatile trusts, but also, notably, including many infrastructure and commercial property trusts. If the tide is indeed turning on the interest rate outlook, then, perhaps surprisingly, it has yet to be reflected in the share price of these sectors. The average investment trust discount remains, meanwhile, back around the 15% level as of yesterday afternoon. To discuss the outlook for those two sectors in particular, commercial property infrastructure, I'm joined this week by Marcus Phayre-Mudge, the long-serving manager of TR Property Investment Trust, ticker TRY, and also by James Dawes, the finance director of 3i Infrastructure, which has some claim to be regarded as among the best of the bunch in the infrastructure space, having matched or beaten its target annualized return of 8 to 10% per annum for several years, and having the narrowest discount amongst its infrastructure peer group. More from both of them in a moment. Turning to the news from the sector, we had a handful of results, including 8 trusts reporting their latest annual figures, among them the aforementioned TR Property, which had a good year, Aberdeen New India, which reported an impressive-looking NAV total return of 31.9%, although that was still not enough to beat the return of that hot Indian market I mentioned earlier. Lindsell Train Investments, whose 2.1% NAV total return lagged the measures it uses for comparative performance by no less than 20% in the wake of continued outflows from the funds that Lindsell Train manages. Baillie Gifford UK, whose unfashionable growthy style produced a modest NAV total return of just 0.6% in its latest 12-month period, that being well short of its 7.5% benchmark. The small-cap specialist Addition Investment Trust, ticker OIT, had a mildly disappointing and negative 3.7% total return, which was some 7% behind its benchmark. And Fidelity China Special Situations, whose double-digit NAV total return of a minus 16.1% was nevertheless marginally ahead of its Chinese market benchmark, China not being the place to be last year. The list of annual results was rounded off by 2 commercial property trusts, Custodian REIT and Value and Indexed Property Income, ticker VIP, the latter one, the first with a negative 0.4% NAV total return, and the latter a negative 9.7% NAV total return. It was a quiet week for other news in the trust sector, though there were some interesting manager changes and board announcements, some of which we discuss in a moment. But you can, as always, find a comprehensive summary of the news, together with our tables of the best share price, discount and NAV moves, on the website if you are a subscriber to the Moneymakers Circle, where this week our in-depth trust profile features BlackRock Smaller Companies, a trust that was managed for many years with a truly impressive track record by Mike Prentice, but has found the going a little tougher since his retirement in 2019. That was well timed with hindsight. At the same time, we have again added more regular information and commentary to our weekly email. So do please sign up for that, as well as look out for our election special podcast, which is coming up the week after next. I'm sure you won't be bored by the subject by then. My first conversation this week, as I've said, was with Marcus Phayre-Mudge, the long-serving and experienced manager of the TR Property Investment Trust, ticker TRY, a unique vehicle in the listed commercial property sector that invests almost but not quite exclusively in the shares of other listed commercial property companies across Europe. With a market capitalisation of $1 billion, the trust is second only to Tritax Big Box in terms of market capitalisation in the sector, and trades on the narrowest discount, despite what, by its standard, has been a fallow period in performance terms, not helped by the sharp upward move in interest rates of the last 2 years, which in turn has helped to make commercial property one of the main drags on the performance of the Investment Trust Index. TR Property did, however, announce its latest annual results this week, reporting a welcome 15% gain in NAV per share and a total NAV return of 21% over the year to 31st of March, some 6% or so ahead of its benchmark. The shares are up 25% since the end of October. Now, for scheduling reasons, this segment of the podcast was recorded before the announcement, also out this week, that the planned IPO of Special Opportunities REIT, which TR Property was proposing to back with a small cornerstone investment, had failed to reach its £250 million minimum raise target and was therefore being pulled. Nevertheless, I have left in my first question when we spoke, which was to ask Marcus why he was backing the IPO, as the answer I think is relevant to the wider outlook for the sector, even though the IPO is not, as we now know, proceeding, and TR Property will not be supporting the private capital raise that the backers of Special Opportunities REIT say they will now be pursuing, that not being consistent with the Trust's now predominantly listed investment remit. The aim behind Special Opportunities REIT, I should add, was to assist in the consolidation of the sector, and notably, it was being launched as a self-managed trust.
There are two reasons why I'm backing it. The first is that I do genuinely think there is an opportunity in the market. There are three sources of assets, motivated rather than forced sellers. So the first point is the market is not in the distress that it was when London and Stamford came to the market in 2009-10. It was not like that. But there is enough folk who I think want to liquidate. And there are three sources. The first is private equity, vintages of 4 or 5 years, structured, probably generally quite levered, money cost 2 and a bit or whatever. Now it's going to be costing 6 plus. Do they want to keep rolling the dice? Do they want to get out? The second area is defined benefit pension schemes, which are increasingly the runoff being acquired by insurance companies who don't necessarily want to own physical assets. And the third, of course, is our good old arch enemy, the open-ended daily dealing property fund, of which there aren't many left. But the very biggest, L&G, is announced that it's going to convert into a hybrid, which presumably means it needs to sell an awful lot of physical property to buy shares. Now, they're not going to move the market. None of this is going to move the market, but there's always deals to be done. And there are moments when money is still quite expensive. And if you do want to get out, you've got to find somebody with the cash. So I think it is an opportunity, but I would just be careful to make the point that it's not 2009. Blood is not on the streets. But in a way, that's a positive for the broader market. We've got opportunities, and I think that Special Ops have been very clear about the fact that they're not going to be making 25% returns in a single year or anything like that. It's not that. It's more of a slower burner. But equally importantly, Jonathan, I think is to do with the fact that the last decade has seen mostly externally managed vehicles raise capital, and they have brought with themselves problems. And the problems is essentially on misalignment. And the misalignment comes because, like all other investment trusts, with the exception of TR Props, which we'll come back to, your fee is generally based on the net asset value of the vehicle, which of course makes total sense when your vehicle is all equities, or vast majority of it is a daily pricing equity or bonds, but not when it's physical property. And here you find, particularly at an inflection point, the manager is feeing off a NAV that's a made up historic number. And the poor old shareholder who actually owns the company is living off the share price and the dividend. And the only business that was correctly aligned was LXI, because they base their fee off market cap. Now, by the way, I'm not some mealy-mouthed fund manager. I'm very happy to pay the management team of any REIT a premium if the shares are standing at a premium. I'm delighted that they're being rewarded for being smart folk and being in a subsector and running a business with the right balance sheet that the market wants. It's the ones who've driven the bus off a cliff who are still being paid on yesterday's price. So, Special Opportunities REIT does answer that. It is internally managed, and most importantly, management are 100% aligned with investors, because in this case, you as the management team can't really make any money until shareholders have been paid out in cash, in full. So I think this business deserves a chance, if anything, to show that real alignment is possible, and to encourage boards of externally managed vehicles to adjust their articles, because, Labs has a 5-year management contract. It's all well and good for the management team to sit there and go, well, we don't care about, we've got our 5-year contract. But that's where the board can say, you might have a 5-year contract, but we need you to start selling and buying back shares, which of course they can do. So you can have your 5-year contract, but it's going to be of something a damn sight smaller. So those are the two reasons. I've spoken for the last 3 minutes about reason 2, when in fact the overwhelming factor, of course, is reason 1. It's a good moment in the cycle, I think, to do this.
So just remind us then, what is different about TR Property in terms of alignment of interest with the shareholders?
The first thing is that we have quite an unusual fee structure, which was created by a chairman, sort of 4 chairmen ago, as it were, Peter Salisbury. And his point was, look, I don't understand the way these funds work, where if you perform in line with the market as a manager, but because the market is very strong, it goes up by, let's make a number up, 50%. In a year, because you have an ad valorem fee basis, you're therefore earning 50% more, but you haven't actually done a brilliant job because you performed in line with the market, hypothetically. In the same way that if the market collapses because of macro reasons and you perform in line with the benchmark, your earnings halve and you're at risk for, some of your team. Can you continue to employ them? And Peter said, I want to do it differently. I want there to be essentially a base fee. We have an ad valorem element because that's what was negotiated at the time. And then if you beat the market, after all the costs and a hurdle of 100 basis points, then, and only then, you can share in a bit of the upside, i.e. you can earn 15% in a performance fee, but you are already comfortably ahead of the market by that point. And my point to the chairman is anybody can buy our benchmark as an ETF product. You can just go out and pay, and then you'll be guaranteed to get the benchmark minus the costs of that ETF or other structured products. So my job is to beat the market. Now, we've managed to do it 12 years out of 13. We have averaged 400 basis points after costs of alpha generation over that 13-year period. Remember that past performance is no guide to the future. But I think at the end of the day, I am always looking, that's my measurement for myself. So we do it a bit differently. And I think that when you look back, even we've done the maths at the AGM several years ago. The then chairman, David Watson, had a nice table which showed that even with that alpha generation, shareholders still paid less right up until a couple of years ago over that decade-long period than if we'd had a 75 basis point ad valorem fee, because, of course, the market was steadily going up. So we think we have an innovative and better structure. But that's not really the motivation behind my comments I made earlier about special opportunities. It's about alignment between management and shareholders. And I think that's something which, as a big fish in a small pond, we own big positions in quite a lot of property companies. We are able to make our views known, and we want management teams to make money. We want them to get rich, but in such a way that guarantees that we as shareholders also get paid. And that's what we're pushing for. And I think that boards have to be careful and they have to be cognizant of the fact that, particularly at inflection points, the net asset value can sometimes mean not actual value. Now, right now, I would argue that in prime West End offices or logistics, industrial, retail warehousing, self-storage, student accommodation, these markets, absolutely, the NAVs are real. They have had their adjustment. They are still popular subsectors because there is rental growth and there is real capital getting behind there and wanting to buy these types of assets. I think very large shopping centres still have a problem because they're still establishing where that base income is going to be, but they're getting pretty close to that. And if you think of the yields now being applied for large shopping centres, and we've seen various transactions in the marketplace, not least Landsec buying out the administrators of Intu's half of St David's Cardiff. We've seen obviously what's going on at Meadowhall, and across Europe as well. We've seen some repricing. And so I think we're getting pretty close. And I would comment that there are lots of companies that report with March year ends. Obviously big ones like Landsec, British Land, but also medium-sized companies like Workspace. They've all experienced the same thing, which is that the decline in values in H2 were probably half or less than half the decline in H1, i.e. the valuation has fallen over the period, but the speed of decline has markedly slowed and in some cases has stopped completely. And allied to that, you take a business like Workspace, where they've had significant earnings growth. They're pushing through an 8% increase in the dividend. And then I go, shock horror, this is offices. So my point being is it's all about offices that the market wants, and there are offices that the market doesn't want. And I was talking to an investor earlier this morning. I was up in Leicester, of all places, seeing a big wealth manager, one of their outposts up there. And of course, being a property person, I spent the night before wandering around on a balmy evening, looking all over the city centre. And it was just shocking. So much of the secondary retail pitches, so coming off the main pitch and the bit behind High Cross, you had ground floor retail units boarded up, all the uppers boarded up. And the problem is that type of real estate is unfortunately not fit for purpose. There's got to be a huge government initiative to bring that back into economic use. Now, we can all spend time talking about that, but the reality of life is the listed real estate companies, doesn't matter if we're talking about here in the UK or across Europe, and of course TR Props is fully pan-European. In fact, we have more exposure to continental Europe than we do to the UK, doesn't really own that secondary and tertiary property. If you think about the listed companies that you know well, be it the Lands, the British Land, or the Seagrows, the London Metrics, they tend to own much better quality portfolio. And then crucially, compared to the private market, they have really quite conservative loan to values. Pan-Europe, we have an LTV on a see-through basis across our benchmark of about 33, 34%. So it really is quite conservative. And it means that if we do start to see there being a rotation of assets, interest rates don't fall as fast as we all hope, and they remain elevated but post-peak, you will see more assets coming to the market. And I think that listed companies, there are quite a number who are in a very good place to raise capital and acquire assets.
You were saying about a year ago you thought there were lots of opportunities emerging out in the property market. And I think you said again in the autumn when we did see interest rate expectations turn for the time being. But it hasn't really happened yet, though, has it? The kind of recovery that you were talking about, it hasn't really been seen yet in terms of the share prices of the property companies. Would that be a fair assessment?
That is a fair assessment. And of course, in a way, you've got to look at both sides of the same coin, or the same sides of the coin, because it's essentially you haven't seen that level of distress. The difference, I think, between, say, the last time interest rates moved very dramatically, so in the GFC, there was also a massive restriction in the liquidity and the availability of capital. This time, the price of it has moved very dramatically, driven by base rates, obviously. But actually, the availability is still there. So you can borrow money. It's just very expensive. And so we haven't seen the opportunities for businesses to acquire assets at knockdown prices. We got a lot of companies that need dramatic recapitalization. We haven't seen a lot of deeply discounted rights issues. I mean, there've been a couple, particularly Sweden, a couple in Germany. But at the same time, what has recovered, or certainly been maintained, is the value of those listed names that are exposed to sectors that have rental growth. Because at the end of the day, Jonathan, real estate, you can either describe it as being at the value end of the equity trade, or it's at the growth end of the bond trade. And what I mean by that is it is ultimately an income-based product. That income's got to be growing, and that's got to be growing through indexation, through organic rental growth, where supply and demand is in disequilibrium, and we've got more demand than supply. And then, of course, the indexation leg as well. And what we're waiting to see is that supply-demand equilibrium manifest itself more broadly. Now, we have it in logistics, industrial, retail warehousing, prime West End offices in the sectors we've talked about. But we just need that to kind of roll out more broadly. And I think what's very interesting in a European context, so many of your listeners will be less familiar with shopping centres in continental Europe, is actually how little tenant failure we've had and how extraordinarily robust and full these shopping centres are. And I would call out a business called Euro Commercial, which owns a lot of shopping centres in northern Italy. I was there the other day and it was just amazing that these shopping centres were absolutely full. There was no vacancy. Now, that just makes me feel warm and fuzzy because, the next step is rental growth. You've got all your units let, you've got another retailer that wants to come in. Well, the only way is to get somebody else out and get this retailer in paying a higher rent. Whereas in the UK, I'm afraid the vast majority of our shopping centres, even our biggest and best, still have quite a lot of vacancy there. And then when it comes to sort of regional office markets, I'm afraid we're still in that process of settling down to this hybrid working environment and companies working out how much space they need. But I would say that no business that I know of is increasing the amount of working from home. If anything, they are reversing that to a greater or lesser extent. So the 3 days in the office is becoming 4 in some instances. You're getting complaints about hot desking. Businesses have downsized. And now, everybody wants to be in on a certain point. And that's where you want to have that collaboration. Now we can't do it. So we need a bit more space. And then actually, when it comes to best-in-class businesses, in real terms, rents have not gone up very much in the last 20 years in real terms. What has gone up and what remains valuable and unfortunately able to go up and down in the lift and not come back in because they've moved to better pastures is, of course, your staff. So you've got to provide a best-in-class working environment. You've got to fulfill your environmental credentials as a large company. So we will see more record rents in markets where there is a lack of supply. And, West End offices are a very good case in point. City, particularly the eastern end of the city and Docklands, very different state of affairs. You've got vacancy of 10, 11, 12, 15% in Docklands. And the type of buildings that just don't necessarily suit everybody because very large floor plates, etc. Meanwhile, regional cities as well. If you're right in the core, Brindley Place in Manchester or down the quayside in Bristol. These markets are, for the right product, they're doing well. I may just move, onto one interesting statistic. This figure is about the global real estate equity market, but it's worth just contextualizing it. I often ask investors what percentage on a see-through basis of global REITs is the exposure to offices. Most people will guess somewhere between 15 and 20%. The answer is 5. So it's very important. And that is a function not only of the decline in the value of offices owned by listed REITs globally, but also the growth of other sectors, be it residential, be it data centers, be it towers, be it industrial, logistics, self-storage, student accommodation, healthcare, et cetera, et cetera. So we all fixate about offices because we're in one. Or you're working from home and you're not in one. Both of which are crucially important. And I think we just need to keep it in context. TR Property right now has virtually no exposure to the London office market. We don't own any Great Portland, Derwent London, Helical Bar, or British Land. We have a little bit of land security, so we have an exposure to the Piccadilly Lights and to Victoria. But, in the grand scheme of things, it's quite modest. Across Europe, we actually do have some exposure, and that's because the return to office has been very comprehensive. Because essentially, I think I've talked about this in previous podcasts, if your commute is half an hour, 45 minutes, often in a private car or above ground, you're likely to go to the office, particularly if you live in the northern hemisphere where for 6 months of the year it's quite cold. Do you want to heat your house or do you want to go to the office and have somebody else heat it? And then for the southern half of Europe, it's very hot. So you want to go to your air-conditioned office because the chances are your home is not air-conditioned. Whereas in the United States, everybody's homes are air-conditioned, even if you live in a trailer. Well, not everybody, but, the vast majority. So it's a very, very different, and you have these very long commutes, and particularly to anonymous business parks. So important not to overly fixate on one subsector.
Coming back to the listed commercial property sector, the investment trust sector at least, you were instrumental last year in encouraging and indeed supporting consolidation in the sector, and 2 or 3 high-profile cases. Since then, we've heard more details of commercial property trusts either going into managed wind down, a couple of Aberdeen trusts are doing that, or there's been a little bit of more corporate activity. We've heard that Brookfield is looking over Tritax Eurobox. I don't know if that's going to happen or not. And we've had the deal between UK Commercial Property and Tritax Big Box. So do you think there's more to come? And I guess in particular, from what you're saying, the future doesn't look like diversified commercial property trust, does it?
To answer that question in particular, before coming back to the broader question on M&A, I think there is very much a home for a couple of well-run, aligned, appropriately structures of diversified trusts. I think there's almost like a home for a one-stop shop where the manager is rotating through those subsectors, through a cycle, focusing on their relationships with the tenants, etc. And of course, the best-in-class example of that is London Metric, which we've been a firm supporter of them. We owned a lot of shares in Mucklow and in CTPT. So we're delighted that Andrew Jones and his team have got London Metric into the 100s. That's a great accolade. So I think there is a home for it. But I think that more broadly, Jonathan, unfortunately, we do need fewer, larger companies. The mainstay, the demand for small property companies, particularly externally managed ones that were sort of creations of the last decade or so, driven by support from wealth manager community who were looking, quite rightly, to find a source of income when, interest rates were zero. They themselves have undergone a huge amount of consolidation, and therefore their big holdings in these tiny companies is, almost a problem for them. And therefore consolidation is the answer. And at the end of the day, a relatively small number of brains can run a large amount of capital. I mean, the core team at London Metric hasn't got any bigger, even though they've just added significantly to the asset base with the acquisition of LXI. Obviously, they need troops on the ground, etc., but the strategic decision-making is still a relatively small team at the top of the tree. When you saw Workspace acquire Mackay, there were 19 employees. I think they took one. There is low-hanging fruit, and there is a win-win-win here, with the exception, of course, of the CEO and the CFO, where there are only 2 seats in a merger and you start with 4 bodies. So there is a problem here from a personnel point of view. And this is where, in a way, it's easier to see the amalgamation of these externally managed vehicles where you're maybe not dealing so much with personnel. But yeah, I think it has to continue. I want to see less managed wind downs. I think they're very dangerous. We weren't shareholders of Custodian REIT or Aberdeen Property Income, but I was very surprised to see some large Aberdeen property income investors opt for a managed wind down rather than merger. I didn't really understand that at all because managed wind downs are fraught. They take time. And the definition of portfolio is there's a dog in there. There's always a few bits at the bottom of the pond, which makes it much harder. I mean, it's all very easy to sell so by the way, they'll probably announce 2 or 3 fantastic sales at book. And then everyone will go, I told you, it's all going to be fine. It's all going to be fine. That's the easy part. That's the first lap of the race, when everyone's feeling buoyant and full of beans. But by lap 12, it gets a bit heavy. And you can see this with the wind down. We've seen it with Drum Property, Palace Capital, these small businesses, REI, they're trying to sell and it's very, very difficult. So hopefully we'll look back in a year's time and everyone will go, we've had our lesson there. Don't do that. That's going to be a difficult route. So that would encourage M&A and, if it has to be privatization, fine. But if there's natural mergers of diversified names, then I think that makes total sense and we will support that because I think beyond London Metric, we do need another one. And I was very disappointed with the merger of Tritax and UK Commercial because I didn't see the business rationale at all, except for the manager. Of course, Tritax owns 60% now. Aberdeen will soon own 100% of Tritax. So they were the manager of UKCM and they're essentially the manager of Tritax Big Box. So it made total economic sense for them to strive for that transaction. Whereas I think for shareholders who are now going to watch Tritax Big Box sell 40 or 45% of the UKCM portfolio because it's not logistics of any shape or size. And of course, Tritax Big Box is now Tritax any size of box, which we have to remember because that's what they're holding on to. Well, at the moment, they're any box and a leisure centre in Kingston and some Cineworlds in Glasgow and some offices in wherever. But put that to one side. So I think there is a bit more of a second leg of this M&A wave. I think that the market would be happy to take paper or paper and cash. And I don't want to see it all go out the door via private equity. But your ingredient still has to be what somebody wants. And my problem with Eurobox simply is that it's what we call a magpie fund. It's got assets in 7 different countries when in fact, as we all know, in the great game of real estate, It's always locals 3, foreigners 1, i.e. in terms of it's a local business. It's about your local knowledge, your local market. And if you talk to any other listed company, it's about that concentration. Talk about British Land, about their campuses, or, you talk to SEGRO about their concentration of their particular sub-markets and where they get that commercial edge. And so I think Eurobox was slightly a construct of its time. And I'm afraid I think it probably doesn't necessarily have a place as a listed company in the long run. It'd be nice if it was acquired by another listed business, obviously, and then they did some consolidation, etc. But I think that's a difficult one for that board.
What about, if I can presume to ask you this, given the context, something like Balanced Commercial Property Trust, that has a market cap of around 500 million. They got one very good asset indeed in the form of St Christopher's Place, the mini estate just north of Oxford Street. Do you think they have a future as an independent investment trust, given all that's happened?
It's a difficult one for me to comment on. Obviously, it's a sister fund inside Columbia Threadneedle, so I'm not able to own shares in it. And therefore, I don't necessarily spend as much time looking at it as I would if I had a position. But what I would say is that I think that the board have now announced a formal strategic review, and that will help concentrate everybody's minds on what would be a best-in-class structure. And I think it is possible to answer a lot of investors' concerns along the points I've made earlier on about externally managed businesses. But yeah, we would like to see a second or third diversified REIT to help investors who just want a one-stop shop. Now, of course, Jonathan, there is a one-stop shop, and that is TR Property Investment Trust. So you would expect me to get that plug in. But beyond that, I can't make any further comments about PCPT.
So if we look across the sector, though, the listed investment trust sector, there's 12 trusts, I think, out of 16 or 17, which are still trading at a discount between 20% or more, and 30% in a number of cases. What's going to change that? Is it going to be consolidation, or actually do you think there is some natural re-rating that could happen if the market environment changes and investors' appetites change?
Yeah, I think there are 3 drivers. One is a self-help one, where these businesses appreciate that they own assets that either the market doesn't like, or if they're really honest with themselves, have got very limited upside in terms of growth, or they've got a lot of costs coming down the pipe with EPC ratings, etc. So they should probably getting out of those assets and buying into what we all want them to own. So there is a bit of that. Now, you may say, oh, Marcus, they'll be forced to sell long way below book. But yeah, but at the end of the day, the stock market is saying, I'm valuing your entire portfolio at a 30 discount. So I say to managers, whilst it's bemoaning their discounts, I'm like, but that's the stock market. That's your register is giving you the freedom. It's saying, we don't believe your asset value. And we're like, fine. So if you then sell these assets below asset value, you're just fulfilling what they say. And if you sell them at a 5 or a 10 discount, then that's great news because you're removing the reason for them not owning the shares. And you're doing so at a price which is a lot tighter to the published asset value than the shares are trading at. So get on with it. Or actually, the market is correct. And in fact, your properties are severely overvalued. So it's kind of reveals these businesses to an extent for what they are. So that's the self-help. The second one is if you are externally managed, then, you need to do the right thing and you need to restructure your fee basis. And by the way, as I said, you're trading at a premium. I'll happily buy your shares and pay you more because you have a market cap base fee. So get out there, do the right thing, get that alignment. And then the third part of this is ultimately those well-run businesses which have good debt structures, particularly, so their interest bill isn't about to shoot up, and where the market is improving and they're able to capture the reversion in rental growth, where they're sort of pregnant with that. And a good example would be Picton Property, which we've already touched on. But, you look at the reversion that Michael has in that portfolio, plus, the stock's trading at a 25, 28 discount, and yet he's just sold 2 of his problematic office assets at premiums to book. I mean, to me, that is a stock that will re-rate for its own internal reasons. And then the third leg of the stool, of course, is more M&A activity. And I think that boards who have brushed away approaches do so now at their peril. I mean, if I stand up at an AGM and say, why did you, Mr. Chairman or Mrs. Chair, why did you not answer that phone call from somebody who I know have been trying to get hold of you? You've got to have a damn good reason. And it can't be, well, because I'm just going to protect the status going there. Oh, they're just bottom fishing. Well, not at all. And what we want from the listed space, what the investors want, is the ability to buy and sell the shares. They want to be able to get into that particular submarket and also to be able to get out of it. And that's the purpose. And the quid pro quo is you, the manager, has permanent capital. It's not like a PAIF where you're constantly worried about redemptions and you need to hold 25% cash, the rest of it. You are a custodian of our capital. And if the share price is going to drift wildly to a discount, you need to understand why the market doesn't like you and do something about it. So I think there is a bit more M&A to come. I think the low-hanging fruit has probably been had. I think that, when we look at the success of the London Metrics deal with CTPT and then again with LXI, that'll be great. It'll be very interesting to see how Tritax get on with this sort of forced strategic sale of 40% of the UKCM assets, which is, again, as I said, a disappointment. And then we'll see what else comes out. I think for Custodian API, we'll look at the wind down. But, there are a few others out there. I mean, obviously, the strategic review at BCPT is something that has to be, and I think it has a continuation vote as well. And then a stock that's very close to our hearts, Phoenix Spree Deutschland, which also has a continuation vote next year. Published asset value is a lot higher than what we think is the real asset value. That's partly about the Germanic approach to valuation. But we still think the stock is trading at more than a 40% discount to what we consider to be the real number. And crucially, the board have realigned the manager's focus. It's basically saying we've dropped the fee because you're not acquiring, you're now just managing out the portfolio, and we are going to pay you for sales that you make. So you're going to be paid 1% of the asset value as asset sales are made. And that's good. Everyone's aligned, and it's helpful that the management team, Q6, own about 9% of the equity. So they're very aligned with us as shareholders. And then really importantly, the Berlin market is in great shape. And the irony, of course, of residential, Jonathan, is that these properties are actually worth more empty than let. So if you can get Frau Miggins out and do up the property and you have the regulation, that the planning consent that enables you to sell it to an owner-occupier, which Phoenix Spree does for about 75% of its portfolio, then essentially you're breaking up these buildings and selling them off. And that's going to be very lucrative. We are firm believers in that particular market.
Final question then, Marcus, which is this. I mean, we've got an election coming up in the UK. We've got a housing market which seems quite hot, shall we say, in some areas. Are there any implications from potential change of government that you can see or worry about or would like to see? The
one to worry about, and we have very little exposure to residential in the UK, and the rented market is some form of localised rent control. They've said they won't make it a blanket, but you can see what problems it brings. You've seen it with Dublin. We've seen it with Scotland. You just basically choke the pipeline of development. So that's something you need to be very careful about. I think from a commercial perspective, I think that there will be, I won't say tax and spend, but there will be an increase in capital expenditure because you've got a 5-year government. You really want to get out there and get the concrete in the ground so that by the time sort of 3 years hence, you can actually got something to show for it. So I think we'll see a boost on that construction side. And then the big one, of course, is what other tinkering you do with the residential market around stamp duty levels or, the bombshell, of course, would be capital gains tax on housing, which I don't think is going to happen. But I would say the risk from a political point of view tends to be on the residential side rather than on the commercial. But then also we would love it if business rates were sorted out. They need a thorough overhaul to enable particularly smaller companies to thrive who, suffering from their inability to appeal the rating list, etc., which takes a very, very long time and such a long waiting list. So that'll be on my wish list and hope list. But broadly, we're not the sector this is commercial, that's necessarily traditionally been very widely impacted by changes between centre-right and centre-left.
Do you have a view about new towns? Is that something where the private sector could be involved in those or not?
Yeah, absolutely. You've already seen it with large-scale housing developments, something like, Urban and Civic, which was a listed company that was taken private by and backed by the Wellcome Trust, building very large new housing developments on it's like Alconbury, an old RAF airbase, and includes primary schools, health centres, etc. So, yeah, I'm afraid we probably do need further new towns. It's really all about infrastructure and linking these places to places of work. But if you really want to get into the nitty-gritty, it's this crazy situation whereby refurbishment attracts VAT and new build doesn't. So you're penalising that redevelopment or refurbishment of inner downtown Leicester, or somewhere I just happened to have been, as I said recently, against, building not on greenfield necessarily, but on brownfield. But it is, there are some very obvious infrastructure plays. And for somebody who lives in the southwest, I've been waiting 30 years for the Stonehenge bypass. They could have done it as a cutting 30 years ago, and everyone would have said, well, isn't that great? We can still see the vista of the Henge. And we would have had a dual carriageway. And the business hours that are lost queuing really all through the summer months, or now all year round. It's a very obvious one.
We all sat there for hours on end with kids screaming in the back, and it's all been a bit of a nightmare. So I think we can all agree that the whole kind of taxation of property rates and so on, it's all a bit of a mess. It could do to be rationalised. I wonder whether that will actually happen. So that was Marcus Phayre-Mudge, the manager of TR Property, the listed investment trust with a £1 billion market capitalisation. I had the chance this week to speak to James Dawes, who is the finance director of 3i Infrastructure, which is one of the largest, if not the largest, infrastructure company listed on the London market, had a market cap of around 3 billion and an impressive track record, certainly over the last 10 years and before that as well. A key change in strategy in 2015, which we'll talk about in a moment. But first, perhaps just for listeners who aren't familiar with 3i Infrastructure, James, you describe yourself as unique. What is unique about your approach to investing in infrastructure, which has become quite a popular asset class?
Yeah, thanks, Jonathan. As you say, there's a lot of different infrastructure investment companies listed on the London Stock Exchange. Some of them are invested in renewable assets and are taking power price risk, for example. So that's one segment of the market. You've got another part of the market where they're investing predominantly in concessions, so in sort of public-private partnerships, roads, hospitals, schools, that sort of thing. So again, you're investing in assets. What we think differentiates us is we are investing in companies, so real businesses with real people. Those companies own assets, but they also develop assets and they have access to growth levers. So that's what we look at. And our key differentiator really is we look to invest in businesses providing essential services backed up by a strong sort of asset base, essential assets, and that we can grow the businesses that they're exposed to market drivers, which we look for long-term sort of tailwinds in these markets. So supportive megatrends we talk about a lot. So that's things like the energy transition or digitalization or the impact of aging population. So businesses where they're servicing the energy transition or digitalization, for example, and these go through the cycles. So the downturn that we saw during COVID, we saw our businesses continuing to operate and indeed, in most cases, continuing to grow through that pandemic period.
I said there was a change in strategy back in 2015. Perhaps you could explain what that involved and what you mean by, you talk about core plus projects that you invest in. Perhaps you could explain what the strategy change was and what core plus is as well, for those who aren't particularly familiar with the jargon of the business.
So if we think about, jargon is slightly, but risk return, at the lower end of the risk return spectrum, so where things are a bit more like a bond, so a limited life concession with a fixed income stream over a limited period, that is appears more like a bond. And then you've got the sort of more core infrastructure businesses, which are typically regulated monopolies, so energy grids, for example, or water networks, water companies. Core plus are things where you have an essential reason to exist. You're providing something that has to happen, but you have some level of market exposure, whether it's sort of contract renewal risk or a more predictable but nonetheless competitive market environment. So typically they wouldn't be monopolies, there would be multiple companies trying to do similar things in the market. So that's what makes it core plus. And the strategy change in 2015 was really narrowing our investment focus to remove the core element and focus exclusively on core plus. And that's because there were a lot of other people, other investors, a lot of money came in seeking the core infrastructure exposure. So lots of sovereign wealth funds, large direct pension schemes, often from overseas, from Canadian pension plans and so on, came in to invest in core, and that drove the pricing up and the returns down. So in order to deliver our target return, which our stated return target is 8 to 10% per annum over the medium term, we can't be investing in things that at various points in time were delivering 6 to 7% gross returns, so net of fees clearly below that. So we narrowed our focus. That was the strategy shift.
And was that because you felt that there was a market for a relatively reliable 8 to 10% return per annum? Was that part of the logic? In other words, you were in a sweeter spot, perhaps, than some of these other infrastructure trusts or companies?
Yes, we preferred the risk-return equation in that part of the market, and we still think that's appropriate. We still think we can get 8 to 10% per annum consistently from our type of assets. And indeed, we believe our portfolio is set up to deliver that. So the current portfolio we have now should deliver that. And also, we believe with these types of businesses that there is access to outperform. So that's something that's key to us. We are aiming to outperform, and indeed over the pretty long term now, we have outperformed that target return. So in the last year, we delivered 11.4%, for example. That's net of all fees.
And what role does gearing play in this? We hear about the reliable returns from core infrastructure and so on, but in terms of gearing and the kind of businesses that you're investing in, what role does that play? Do you use that gearing in order to get up to 8 to 10% your target returns?
At portfolio company level, we do gear our portfolio companies. What we think is an appropriate level. So approximately it's 1/3 debt to the enterprise value of the businesses. That's the weighted average across the portfolio. We target investment grade structures, so BBB or BBB minus. So either where we have a rating, so some of our businesses do have a credit rating and maintain that rating, or where we understand the ratios and the rating models so that we target structures that would be equivalent to investment grade for those companies. And that debt is almost all fixed rate. So either it is fixed rate or it's hedged to be fixed. So over 90% is fixed at the 31st of March, which was our last year end. So we think we have a pretty prudent approach to gearing. So our returns that we have from the portfolio, and we state from the portfolio, and it's 11.3% is our weighted average discount rate or weighted average return from the portfolio. That's the geared return. So we're not then applying any more leverage to that to get to our net return targets. Over the long term, we view that we manage our balance sheet for 3i Infrastructure to be symmetrical around zero. So zero cash, zero debt. So we don't want any enhancement at the top co.
We know that one of the reasons why infrastructure has become such a popular asset class, certainly with large institutions, pension funds and sovereign wealth funds and so on, as you say, that's partly because of the nature of the assets and the need for those assets. But it's also something to do with the kind of returns that they generate. So a lot of people have been attracted to it by the dividend returns and the kind of yield they could get following the GFC when you couldn't get returns on money. But you're different from that because your dividend yield is not as high as most of the others. So you're differentiating that way as well. It's somewhere between 3.5% and 4%.
That's right.
So who is the market for buying your particular kind of infrastructure ventures?
So we are a conduit for savings into private infrastructure companies. And just being clear again, we're not investing in assets or projects directly. We're investing in infrastructure companies, which are often developers of those assets or projects. So we are offering a total return of 8 to 10%. So within that, there is a progressive dividend policy. So we've been growing the dividend every year, dividend per share, since the company started. So there is an element of yield that is important for our shareholders. But really, we are differentiating ourselves through growth and the provision of growth and therefore the total return. So our shareholders understand that that's what we're offering. And the way that we can position our businesses to deliver growth and then eventually we are likely to sell them on, although not under any time pressure to do so, is because we buy well. We buy typically businesses that are not seen as core infrastructure, as we talked about earlier. And then over the life of our ownership, we transform those businesses, we grow those businesses, and we reposition them so that they are seen as core infrastructure. So we can then sell them on to, as we talked about, direct pension plans or other managers who are prepared to pay a higher core infrastructure price for a business like that. And we had one example in the last year where we did exactly that. It was a business called Attero, which is a Dutch waste treatment business. And we did a lot of work to grow that business, double the size of the earnings of that business over our ownership period, and made it seem much more as a core infrastructure play and sold it on that basis.
So that's a kind of model for what you ideally will be able to achieve.
Yes.
And in your portfolio, how many businesses do you have in your portfolio and how often do you, on average, hold them and how many do you try to realise every year? Is there a trend there?
So we're very flexible. There are 12 companies in the portfolio. That feels like a good number. We don't want it to shrink materially, but equally we don't want it to grow materially. That's in terms of the active asset management that we have with 4 or 5 people in our investment team on each of those assets. It's a very engaged asset management approach. It's the private equity approach. We control the boards of these companies. So for almost all of them, we have a majority position. 2, we are joint control alongside the operators of those businesses. So that's about the right size by number. Could you remind me of the other part of your question, Jonathan? Sorry.
How many do you realise every year?
So there isn't a target. We're flexible. We realised one last year. Maybe one a year would be about right, but it doesn't have to be every single year. In terms of the life of the companies, a lot of the companies we've owned for 7, 8 years, a number of them. And we've got one that's been in the portfolio since, I think it was 2008, so a pretty long-term hold there. So we're very flexible. That's one of the beauties of the investment trust structure, is it gives us that flexibility. We're not beholden to a sort of fixed, raise your money, invest your money, realise the assets timetable, which is what a private fund would be beholden to.
They might typically have a fixed life, as you say, or an exit opportunity required, yeah. So if we look at your investment trust, you mentioned the advantages of the structure, but one of the disadvantages is that the share price can be quite volatile. And for most of the last 10 years, your shares have traded at a premium and you've been able to issue some more equity. But in the last year or so, you have traded at a discount, along with everything else, went out to something around 15% or 16%. Now it's come back in again, and you have the narrowest discount in the whole sector, it's fair to say. So what do you think has been going on there? Is that a case of people just having a knee-jerk reaction, interest rate risks or interest rates rising, let's devalue a trust that is in a core infrastructure business? Or is there something else at work here? You actually had sellers as well as driven this discount out?
I think you've hit on it. It's interest rates. The rise in interest rates hit the whole sector. It hit us less because we're doing something different. We're less of a bond proxy than other infrastructure companies. So, as you said, we're on the tightest discount. It's definitely single digits now. And so I think it looks like we're at the turn of the interest rate cycle now. So I would hope to see, at the very least, that our growth in net asset value will transmit through to the share price performance, from now on as the new downward part of the cycle takes hold. And it has started now in Europe in the last week. So that's interesting to see.
Indeed, it has started, yeah. But what's your attitude about discount controls? Or what's the board's attitude about discount controls, I should say, because they determine that. Let's put it this way. Do you want to get back to a premium and have the option to raise more money if the right opportunity came along?
Well, we're very focused on performance, and clearly narrowing the discount will improve the returns for shareholders. So that would be a good thing. We are fully invested, so we're drawn into our credit facility at the moment. Certainly given the size of the discount we're trading at the moment, which is relatively narrow, we don't believe it's a better use of money to borrow more to buy back shares. Rather, we're in the mode of trying to repay the borrowings and invest through our portfolio companies. So not adding new portfolio companies, but investing through the ones that we have at the moment, where we've got good line of sight on delivering returns from that new investment that is well in excess of our return target, and indeed in excess of the returns that we are valuing our businesses on. So it is something the board considers, share buybacks. It's something that we have an eye on, whether that's a good idea or not, but at the moment we don't believe it is.
I guess a subsidiary question to that is, do you think that there are still some outstanding opportunities out there in your particular sector of the market? Or what would it take for you to have another strategic rethink, given the way that the prices of assets that you're involved in might be moving?
Yes, so I don't think there's a need for a strategic rethink in terms of what we'd buy. As I said, we're very focused on investing through the portfolio companies at the moment. That's where we can get the best bang for our buck. And so we're not looking to add a new company to the portfolio. But over time, as we realise some assets, that should free up capital to reinvest in new businesses over time. But we've never been a larger issuer of equity. I think some of the other businesses where their model was to acquire and hold concessions, for example, through to maturity, and they were issuing equity to be able to do that. That hasn't been our model. We've issued equity a relatively small number of times over our life. That's why our share price starts with a £3 number rather than a £1 number, which is what the other listed companies do, even the ones that launched at a similar time to us.
Right. I take your message there. One reason for that, of course, which I hadn't appreciated until I sort of looked into this a bit more closely, is the way you're rewarded. The incentives in the way you've structured your business are quite important, aren't they? I mean, a lot of other funds and trusts are incentivized to be asset aggregators, to grow the size of the business because their fees go up accordingly. I think, but you would claim that you're not quite in that position because you have a slightly different structure. Is that right?
That's right. There's a couple of elements to that. One is that 3i Group, who I actually work for, 3i Group is the manager of 3i Infrastructure. 3i Group owns just under 30% of the shares in 3i Infrastructure. So we're a large investment on the group's balance sheet. So the performance of that large investment matters an awful lot more to 3i Group than the fees. The fees are a factor and they are a consideration, but the performance of the capital put to work is much more important. And alongside that, since the launch of 3i Infrastructure, there's been a performance fee. And we think that incentive does align interests with the investors. We are aiming to deliver the strongest performance for our shareholders. So that is a key part of the incentive for the management team.
But you might still have an incentive to take more risk than you might otherwise be comfortable for, because that might juice the performance in the short term. Would you not? I mean, that's a common criticism you hear of performance fees.
No, absolutely. We have a longer term performance fee structure. There's a sort of 3-year deferral with a clawback if we then subsequently underperform. So the structure has been put in place to take that into account. But we think it's sort of performance every year. It's set up to be a long-term performing vehicle. That's what we're trying to deliver.
And so looking to the future now for 3i Infrastructure, you've mentioned the attractions of having permanent capital and so on. Is it just business as usual from here on? What are the biggest risks you face? Obviously, interest rates might be one of them if they go up again, as far as the share price is concerned. But from the underlying businesses, what's the biggest risk? What keeps you awake at night?
Well, I think we've constructed a portfolio where the supporting trends, the supportive mega trends that I mentioned, see us through in terms of performance across the economic cycle. I mean, there are political risks. We've woken up this morning to find there's a snap election in France, and we have some businesses exposed to France, so things like that. There's an element of geopolitical risk that I'm sure we're all concerned about. But I think the infrastructure characteristics of the businesses that we own and the essential nature of what they do really give us a strong downside protection. So whilst we keep an eye on it and we run a risk register and keep an eye on all different types of risks, I think the opportunities around the energy transition that I mentioned, digitalization, are very strong opportunities that won't suddenly evaporate because of change in governments, for example.
Just on energy transition, I mean, there has been a bit of a sort of kickback against some of the policies that governments have introduced in the energy transition sphere. They've been sort of deferred or delayed a little bit. People think they've gone too fast. Is that going to have an impact on the companies you invest in who are following that particular theme?
I think sometimes some projects have been slowed down. I think in the UK, one of our businesses is developing renewable energy. This is a business called Infinis. The Labour Party have made a big play about they're going to reform the planning system to make it easier to get important planning decisions made promptly. So that would be a benefit. As I'm sure you and your listeners will have heard, it's very hard to get new grid connections, for example, because the planning system is pretty slow. So things like that would be beneficial. So I think there have been some delays in offshore wind projects. Those have now restarted, and we've got a business involved in servicing offshore wind projects. But I think once these things are approved, they will happen. They need to happen. We need to be generating renewable electricity. That's not going away.
So that was James Dawes, the Finance Director of 3i Infrastructure, talking to me this week about his hopes and experience over the last few years.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.